Right, good afternoon, everybody, and welcome to the first Essentials of 2022. I certainly talked to you on a very turbulent day today. Today we have Nolan Wapenaar, who will be presenting to us. Nolan is the co-CIO of Anchor Asset Management. He's also the head of fixed income. In today's session, should you have any questions, please put them in the chat function, and Nolan will try cover as many of them as we can. Once again, my name is Dale Franklin. Welcome to Essentials. And without any further ado, let me hand over to Nolan.
Thanks very much, Dale, and hi, everybody. I appreciate you dialing in on a day like today to actually chat to us. I realize that everyone has a heck of a lot going on. And, in that context, I was asked to talk about the essentials of South African inflation as a first topic. At the time we chose the topic, it seemed incredibly relevant. And in fact, we had a lovely starting slide lined up to talk about global recovery, to talk about how it's continuing at a slower pace, and, the COVID mask, talk about Eskom and all the other pictures. And then this little picture there on the top talking about Russia and Ukraine. And that's kind of what it was, as a sort of small starting point. As things turned out, we woke up to this morning. And we pretty much spent the morning fire drilling and looking at portfolios. I think that's the most important thing we do. But at the same time, in the background, we've been reworking the presentation to try and sort of incorporate more of an update on what's going on and what the implications might be, with a view towards various investments, specifically though looking at inflation. So we've done that. I'm going to try and talk for somewhere between half an hour and 45 minutes. This presentation update was completed maybe 10 minutes ago, to be honest. So, we're sort of feeling our way through it at the moment. But without too much further ado, I guess, what happened overnight was that the Russian president, Vladimir Putin, announced a form of attack on Ukraine. He's announced that he is going to conduct military drills in Ukraine, I think was the starting point of it. And that sort of escalated towards specifically targeting military installations. Looking at this, it's actually been very, very difficult to really get a good handle on what's going on in the ground. You see comments from the Russians, which are conducting military drills. You look at comments from the Ukrainian president, who's calling it a full-scale invasion. You look at pictures that are available from news outlets. You look at pictures on Twitter, which generally tends to spread pictures very quickly. And there can be no doubt that there has been some form of military attack. There's been very clear action. There have been significant numbers of troops deployed. But what we have not seen at this stage is widespread destruction. So, it seems to be very targeted at this stage, is the first comment I'd make. And that's maybe good, but it's also bad because, it could escalate, it could de-escalate, and I'm just lousy at forecasting. So we're all sitting here running sort of various what-if scenarios because you don't really know where it's going on. It also appears, and it's becoming increasingly evident, that the Western allies are going to respond to this with a pile of sanctions, a significant sort of basket of sanctions that are being negotiated at a G7 summit this afternoon. But it doesn't feel at this stage as if we're going to see military boots on the ground from the G7 countries. So for now, it seems to be, Ukraine is kind of being left to deal with it while they're cutting Russia off from the rest of the world economy. We need to unpack what that means for everyone, particularly in the context of inflation. But before we do that, just as a bit of a background, what is this really about? Well, it's all about NATO. And what happened was that the Ukraine has been making a lot of noises about joining NATO. So NATO, just as a history lesson, was founded in 1949. And the idea was that it was the North Atlantic Treaty Organization. And they were a group of countries that came together with the idea of protecting the Europeans against Russia post-World War II. So that's the sort of backdrop of what NATO was, but it's grown over the years, and it's actually taken on a broader meaning because it's become a bit of a sort of, pro-markets Western world club, as to, which is sort of pro-democracy and pro many of the other things that we tend to take for granted. Now, the problem is Russia, this is a problem for Russia. So if you look geographically, what you've got is Russia kind of top right-hand side of the map, bottom left, you've got most of the EU. And there are three buffer states between Russia and the NATO states, which are Belarus, Ukraine, and Georgia at the bottom. So both the Ukraine and Georgia have made applications to join NATO, to become part of NATO. And in fact, Ukraine in particular is becoming increasingly aligned with Western policies, the Western way of doing things. And as a result, what we're seeing is, this is unsettling the Russians. So specifically, this is what sparked this off. And what Putin has said is that he really wants to have some form of veto power to prevent these countries from becoming more aligned to the Western countries over time, so as to prevent, so as to retain that buffer between Russia and NATO and Russia and the West. So that's where this all sparked. But I'm not an economist, a political analyst. I'm certainly not a war analyst. I'm here to talk about what that means for inflation rates, what that means for the rest of the world, and for our investments. And I want to start by looking at the forecasts from the US Federal Reserve for inflation over the last few years. So if I start on the left, January 2021. The Fed was saying inflation expectations were going to be anchored at about 2%. Through March last year, inflation at 2%. And then sort of June, we started to see inflation expectations creep up, 2.1. By December, the Fed was going, well, inflation might hit 2.6. January this year, they didn't actually release inflation forecasts, but they'd started to prepare the market for, a taper and quite significant rate hikes. And we think that their inflation expectations are certainly pushing higher. The 2 points I'd make from this. Firstly, is that we are in unprecedented times. So inflation expectations have been pushing up. But if the Fed is unable to forecast inflation, which it has been, it's also going to be unable to forecast where interest rates are going. So, sitting and agonizing, for instance, over the Fed's dot plot where they all sort of put dots as to where interest rates are going is kind of irrelevant because their underlying inflation forecasts are proving to be off right now. And that's part of the challenge we face. What we do know is that inflation is significantly higher than people expected. Inflation is taking longer to come down than people expected, and that the Fed is going to need to react. It's going to need to tighten monetary conditions, i.e., run off some of its balance sheet, and it's going to need to raise interest rates. So what does the Ukraine-Russian situation mean for all of this? Well, the biggest impact on inflation is actually oil and natural gas. Specifically, Russia exports about 10% of the world's oil supply. So this is a significant impact on oil supplies. And Russia also produces about 40% of the natural gas that's used in Europe. If we look at natural gas, there are 2 points to be made here. Firstly, fortunately, in terms of timing, we're coming out of the European winter now, so gas demands are going to naturally come off as we head into warmer months. So for now, it's potentially less devastating than if this had occurred in November. However, make no mistake, this is going to be problematic for Europe. Looking across at the US, though, it's important to note that the US is actually a natural gas exporter. So they produce enough natural gas for their own purposes and export the excess. So from a direct impact on US inflation and consequently global liquidity, this has got the natural gas prices have far less of an immediate impact, and it'll be delayed into next winter almost. In terms of oil prices, this is probably more concerning. We've seen Brent crude pushed to about $105 a barrel. That is problematic. I mean, that basically means the Rand petrol price is probably going to be somewhere around 22 Rand a litre in April. That's ouch, and that's going to have inflationary impacts. If we look at the oil, the key question we keep getting asked, we keep asking is, well, why aren't shale producers coming online? Why are we not seeing, these the shale producers sort of fill the gap and manage prices down? The long and the short of it is that US shale producers actually become quite profitable at about $60 a barrel. So this is quite a lucrative opportunity for them right now. The issue is the US has been pretty lousy at issuing various permits and certificates, and consequently, actually turning on shale production in the States is more difficult than a lot of people realized, just because of all of the sort of red tape and bureaucratic nonsense that's been there. So the US shale producers haven't really been able to fill the void. If we look further up the cost curve, though, the next level of shale producers are actually out in Canada. Now, their cost of production is about $120 a barrel is where they become quite profitable. So that creates a natural ceiling for oil in our minds. And that's actually, something we're looking at the moment. So we see, a risk of, if this does continue to escalate, I think that, the natural ceiling for oil is somewhere around $120 a barrel. That's still lousy as a South African. With, $120 a barrel, we're now putting the petrol price at kind of 25 Rand a litre, assuming the Rand stays stable. So from that perspective, it's certainly not something we like. And in fact, if we look at what this means for the global economy, I was looking at research this morning that says that on average, if for every $10 the oil price goes up, what you're going to see is headline inflation in the US increases by 0.2%. So, if we've seen oil 30, 40 dollars a barrel higher, that's up to 0.8% of additional inflation in the US that's coming through. And that's something we do need to be aware of. I'm going to talk about South Africa in a few minutes. We also need to be aware that, if we look at core inflation, or PCSE inflation, which is what the Fed focuses on, that strips out the effect of oil prices, but they're second order effects, transporting goods, to shops, etc. And even that is probably going to be about 0.1, 0.2% higher. So we've been in a high inflation environment. It's going to get worse because of the events in Ukraine. But it's not just about inflation. And, what we need to look at is what's going on economically. If we look at economic growth rates, and I literally just take economic growth rates of last year versus economic growth rate forecasts for next year, and I take the IMF numbers here produced in about January, what you can see is the US last year grew at about 6%, and I think it was 5.9 actually, and it's forecast to slow down to 2.2%. And across the globe, you've got a situation where, we've had the bounce back from COVID, and now economies are slowing back to their traditional paces, if not in some cases slower. That's a significant slowdown. And, a lot of the talk about interest rates going up, a big event is taking place. Interest rates are going to be hiked in an environment where your economies are naturally slowing. Normally, interest rates are hiked in economies that are still accelerating. So this time around, it's a little bit more difficult. They're hitting the brakes in a car that's already slowing down, and that creates more of a risk for policy mistakes. The other point is, what does Russia-Ukraine mean for economic growth rates? Well, the long and the short of it is that for every $10 the oil price goes higher, you can expect to shave about 0.1% off your economic growth rates. So, if the US was expected to grow 2.2% next year, and that's based on January numbers, oil prices are now, $30 higher. You can shave 0.3% off that. Right now, US forecast is probably about 1.9, and the risk is it could actually get quite a bit lower. So this creates this difficult dynamic where the central banks are looking at inflation, they're feeling uncomfortable, they need to hike rates, they need to respond. But at the same time, you've got a lot of events taking place in the world that are slowing economic growth. And I've seen a flurry of analysts writing articles today about, will this slow down the US Fed's hiking cycle? Anchor's view right now is no, it probably won't. We think that the Fed is going to be first and foremost focused on inflation, and therefore they will hike. notwithstanding a sort of slower economic growth. And there is, in our minds, a small risk, certainly not a base case, that the Fed might go too far and put us into a recession. But for now, we think it's, the rate hikes continue as expected, and, inflation will be a little bit higher for a little bit longer. So what's the impact of this? What's the impact of hitting the brakes, if you want? And investors have benefited. It's been a wonderful time to be an investor. You've had various portfolios that have grown by 100% in a year. You've had a number of great outcomes in equity portfolios. You've had great outcomes in fixed income portfolios. But I think the heyday has probably passed, and returns are likely to be lower going forward. And that's something we need to sensitize our clients to, is that, returns are still probably going to be positive. I think global equity returns are probably positive over the next year, but it's not going to be a massive positive. It's a lot smaller than people experienced in the past. Same applies to bonds. However, it continues to be positive. It continues to be a good investing opportunity, investor environment. It's just we need to recalibrate expectations, and that's that's one of the key messages that we're trying to get through to and trying to communicate to investors and to clients. But let's talk about the rand. And the rand has been a little bit unusual because it's almost been a safe haven currency. It's it's been incredibly stable. Last I saw was about 15.26, 15.28, something like that to the dollar, notwithstanding everything that's going on. And I think there are two reasons for that. The first is the rand has been oversold for a while. Anchor subscribes to the purchasing power parity model. And what you can see is, the sort of stable black line, which is where our PPP line is, where we think the fair value of the rand is. And around that, we put a bit of a trading range where we think a fair range is. Rand never listens to our PPP models. You've got the jagged blue line trading all over the place over time, but it tends to sort of gravitate towards our PPP values, if you give it enough time. Our PPP model, we published a document at the beginning of our Navigator, actually at the beginning of January, where we said that we think the rand will be the fair value is probably 14.50 to 15, but in the context of the global environment, we think the rand will trade a little bit weaker than that. So we've said just a little bit weaker than 15, and it's actually been pretty consistent in doing that. So the rand's very much followed, what we'd expected. And if we extend that out further, a couple of key things to take note of. Firstly, because of the higher US inflation, our PPP model is actually turned down, and economic models are suggesting that the rand should strengthen from here, which is kind of unexpected. I think first time in my career I've seen this, but models are actually suggesting the rand should continue to hold up well, which is quite pleasant. But there have been other factors as well. And one of those is that Russia accounts for 44% of the world's palladium. It accounts for 6% of the world's iron ore. It accounts for 14% of the world's platinum and 10% of the world's gold supplies. So if we look at all of this and you take that producer of all those commodities out, one of the commodity producers that stands to benefit is actually South Africa. And you're seeing that today. Platinum shares up 10%, for example. So what you've got is a situation right now where our terms of trade are hampered by a higher oil price, but at the same time, our terms of trade are benefiting from other commodity prices, our export commodities going higher. And if you buy into the view that, the Canadians will probably keep oil somewhere between $100 and $120 a barrel, which seems like a reasonable view, actually our terms of trade improve. There's a reasonable prospect of South Africa having a wider current account surplus than originally forecast, just by virtue of getting higher export prices. So from that perspective, the rand is actually, in the short term, we've seen the risk-off environment, we felt the pain. But in the longer term, this could actually prove to be a little bit more rand supportive, once the dust settles, hopefully soon. And then the other big point to note is if you're sitting in London or in New York as an emerging market investor right now, and you've got to be invested, who are you going to be underweight? Well, I'm going to be underweight Russia, I'm going to be underweight Eastern Europe. But then I've got to be invested somewhere else. And where's the overweight? Seems like South Africa is a good overweight. We've had a good budget. I think it was quite solid. I know that people are throwing stones at it. I know it's not perfect. I think it was as good as could expect. I think that the government is slowly, regaining trust. I think economic growth will continue to be positive. And to be honest, right now, given a choice of investing in Eastern Europe or in South Africa, investors will take South Africa. So what has happened is for a lot of these investors, South Africa becomes a bit of an overweight choice versus their benchmark, so that they can go underweight elsewhere. And again, that actually, it's maybe the least dirty shirt argument that I'm sure everyone's familiar with, but that again tends to help South Africa. So South Africa looks to potentially benefit a little bit in the long run. In the short run, though, the risk off is going to keep hurting us. Looking at South African inflation, and what I've got here is South African inflation minus US inflation. And you can see you can actually almost see different Reserve Bank governors. So for the first portion of the chart, what you've got is the Jill Marcus era, where she ran inflation at 6%, US inflation was 2%, the differential was about 4%, and you can see over time how inflation tracked. You then had Kganyago, who came in, and he said, no, our South African target inflation needs to be 4.5%. He very successfully managed it to 4.5%. You can see how the differential came down, and then tracked along at 4.5 minus the US 2% equals 2.5% differential, and that's worked very well. Finally, though, getting to the end of the graph, what's now happened is through COVID, through the supply chain blockages, through rising goods prices in America, you've actually got this weird situation where US inflation is higher than South African inflation. Again, that's what's keeping our PPP model pointing for a stronger rand right now. But at the same time, that's got other profound effects. For instance, it's got a massive impact on interest rate hikes in South Africa, which necessarily will be fewer than the US. We just don't need to chase inflation in South Africa, and that's a more, gives us a much more attractive bond environment in South Africa. But looking at South African inflation in a bit more detail, what I've got here is a chart looking at the inflation print from January this year. And I've taken the inflation items per Stats SA and I've sort of listed them. On the left-hand side, you've got the sort of blue bars. And the blue bars represent items that have inflation below the lower end of our target band. South Africa's target band is 3% to 6%. And all of these items, communication, beverages, clothing, housing, recreation, household components, are actually sitting with inflation below 3% right now. The gray bars in the middle represent items that have inflation within the target band, so between 3% and 6%, personal care, health, tobacco, education, alcoholic beverages, restaurants, insurance, food, and financial services. And then right on the right-hand side, you've got the two items, it's only two items, where the inflation on those two items exceeds the target band. And those are the two items that are pushing our inflation higher. So from South Africa's perspective, our inflation is being driven by Eskom, electricity tariff raises, and transport, cost of petrol. Everything else is actually within the band. And interestingly now, if we go and look at what's happening in America, what you're going to find is a lot of those items that are in the blue or in the gray for us, household contents, goods, cars, personal care, etc. Those are the items that are actually pushing higher, but they have not done that in South Africa. They haven't done that because we don't have a strong consumer demand. We don't have a strong consumer balance sheet. If anything, actually, we've lost a lot of jobs through COVID. So we don't have that strong demand that's pushing inflation on those items to the extent it is elsewhere. And that's one of the reasons that we don't need to see as strong an interest rate hiking cycle in South Africa. And it actually gives us a lot of comfort to own South African bonds. But let's talk a little bit about Russia and Ukraine again. So one of the worrying factors about the Russia-Ukraine conflict, and there are many, is that the two countries account for 80% of sunflower oil exports globally. They account for 28% of wheat exports and 20% of corn exports. Where I'm going with this is that global food supplies are going to be impacted. And this impact on food supply is going to see food inflation push higher. Probably good for South Africa. We are a corn exporter in good years, not every year. So we may be able to capture some benefit from this. But sad reality is that global food inflation is going to be under pressure, and it very, very much, we now expect that the food bar will move from the gray to the red in South Africa. Electricity tariffs, were, I think, 14.7% last year. So that's the electricity inflation you've seen. Eskom has applied for even greater electricity tariff increases this year. We know from experience NERSA doesn't give them everything they ask for. So we expect that will be pared down and probably maintain sort of around the current levels. Again, electricity is going to keep us our inflation under pressure. Transport is the big problem, and it's all about the petrol price. Petrol at 22 Rand a litre, I think, is almost inevitable at this stage. It was good to see that the Minister of Finance didn't increase the levies on fuel, and I think that's because he knows petrol prices are about to go up quite dramatically. Certainly, if we see the $120 a barrel, that's 25 Rand a litre, and then we're beholden to the Rand. It's not impossible that the Rand comes under pressure, and that could push petrol prices higher. I see some analysts talking about 30 Rand to a litre. I think that's probably extreme. We've got to put very extreme scenarios into our models to get to there. But the point is that fuel price inflation is probably going to remain high for a while. The weird thing with 1 year inflation is it kind of depends a little bit on what drops out of the 1 year period and what comes in. So the numbers coming in are going to be a lot higher, but we've also got some big base effects dropping out. So net, we think that transport inflation probably hovers around these levels as well. What does that all mean for inflation? Probably a little bit higher from where we're at now, not dramatically so, remains within band. And we think that gives the Reserve Bank, an opportunity to be sensitive as to how it hikes interest rates. And in that regard, I'm going to just take this opportunity to introduce Casey. Casey is our economist here at Anchor. And she sort of focuses on economics and fixed income and impacts of inflation and interest rates. So I've asked her just to explain this one slide to you, and then I'll take over again.
Great. Thank you, Nolan, and good afternoon, everybody. So as Nolan mentioned at the start, we had a very different presentation planned for you all today, only to really wake up this morning and realize that more or less most of what we had planned to say today became more or less a moot point. But up until now, Nolan's done a great job of explaining the context, where do we find ourselves at the moment. So for the next 5 or 10 minutes or so, I want to attempt to bring that back down to the local level. Really, what does the impact mean for South Africa, particularly with regards to fixed income? And also as sort of to remind that there are other factors at play at the moment that are very important within the local sphere, aside from just the Russia-Ukraine story. There is more still on the ground happening. So if you look at the graphic in front of you, you can see we've illustrated what would be your generic bond yield curve. On the x-axis, we have our term to maturity, and on the y-axis, your yield to maturity, essentially your percentage return. So when we consider the type of factors and the issues at play at the moment that Nolan's alluded to the last little while, we typically think in a fixed income perspective, yields are either going to go blow upwards or downwards. But in reality, it's a little bit more complex than that. And it's important to consider each individual factor and where that will sort of impact the yield curve. Because at the end of the day, certain factors impact the yield curve to varying extents or degrees. So if we look at the left-hand side of the curve, that is typically, or should I say the left-hand block, that is typically your short-term dated debt. And at the end of the day, that's really driven by the man you see in front of you there, the governor of the Reserve Bank, and the decisions driven by the Reserve Bank. So essentially your monetary policy. And in the current context that we find ourselves at the moment, this is really largely being driven by inflation. There are some indirect factors that will impact across the curve, such as your growth, your credit extension, etc. But really at the moment, what we're focusing on is inflation. It's in the current situation where we're seeing heightened global inflation and locally as well. This will, of course, will turn the reserve banks across the globe, including our SARB, to drive interest rates higher in order to counteract this inflation, which in turn then drives our, typically on the short end data of the yield curve, drives that part of the curve on an upwards direction. If you look more towards the middle end of the curve, so what we call the belly end of the curve, so that's typically your medium term sort of dated debt, It's a little bit more complex and not really what I sort of want to discuss today, but that's typically driven by the more academic sort of technical factors, your trading activity, functions of demand and supply, auction results, etc. So hence not really what I want to focus on at the moment. If we move more towards the right-hand side of the curve, so that is typically your longer-term dated debt, your sort of real long end of the curve. And as you can see, that's normally where it becomes very interesting and is driven largely to the extent by the man you see there in front of you, our President Ramaphosa, and sort of your government policy movements. So from a fiscal aspect, we think about our revenues, our expenditures. Where are we sitting there? Are we still driving towards a situation of fiscal consolidation? Where are our debt trajectories? Off the back of that, our credit ratings. Are we on a negative outlook, stable outlook? Where are we sitting? Junk status, investment status? That really sort of drives the back end of the curve. And importantly as well, you have your event risks, your idiosyncratic risks. For instance, we had the civil unrest last year in July that impacted the back end of the curve quite significantly. COVID, of course, would have fallen into that category. And as we've been speaking about for a while now, the Russia-Ukraine tensions will very much be impacting this end of the curve. But often not in a way that one would typically expect. We see a bad news story and automatically assume sort of bond weakness. But as Nolan mentioned a while ago, I should say a few slides ago, that this could actually be net positive for South Africa in the sense that if there's a high demand for our various level of exports, that of course means greater export revenues, higher corporate income tax, which is very positive for our revenue space, our fiscal situation, helps bring our debt trajectories downwards and can help keep the rand buoyant. So at this point, we're seeing a bit of a trade-off between the positive factors that this could drive for South Africa, along with the good news story that we had from budget yesterday, versus the inflationary pressures that we will be seeing. So if we sort of net these all together, what we see is more of a sort of flattening of the curve, downwards being pulled downwards by the long end and pushed upwards sort of by the short end. So it's not just a case of yields blowing either upwards or downwards. The shift of the curve is very important to consider because naturally this in turn impacts your investment portfolios, your fixed income space, which is then probably my cue to hand back to Nolan to explain that part in a little bit more detail.
Thank you, Casey. So pulling it all together, how are we thinking about the inflationary environment right now, particularly in South Africa? And really we're thinking along three scenarios. The first scenario is that inflation slows as is expected. And what does that really mean? It means oil up to about $100 a barrel, I guess is one way of looking at it. Your inflation is probably going to be about 5% this year, maybe a touch higher, 5.1 on average. We're going to see inflation spike through the 6% level probably towards the end of first quarter, early second quarter, and thereafter roll down. And then maybe towards next year, you're going to see inflation about 4.8%. In that kind of environment, actually, what you're going to see is the Reserve Bank is still in a position to make measured interest rate hikes. We think by year-end, interest rates are about 1% higher. Realistically, we think there's a very high probability of a 0.25% hike at the next meeting. Next meeting is next month in March. And then what they'll probably do is start to pause and then hike and pause and then hike. And that type of environment is actually very positive for bonds because bonds have taken a far more conservative stance on interest rates. And if bonds are too conservative, as they sort of recover to what's fair, what's realistic, the bonds are going to show some capital gains. So in that type of environment, from our fixed income desk, we believe that it's bonds all the way, and you probably want to own some listed property, and that's the environment that would those are the assets that would be supported by that environment. The next scenario we look at is what if inflation remains sticky at the 5% to sort of 6% level for the next 2 years, doesn't come down as quickly. Potentially we're now talking about oil, this isn't a spike, this is a longer term structural change. Oil is going to hover around the sort of $110, $120 a barrel. Inflation breaches the target probably for the next 3-4 months and then starts to come down. On average, we're still at 5%. In that type of environment, the Reserve Bank has to hike faster. So we think that there's still a hike of 0.25% next month, March, but then at the next meeting and the next meeting and the next meeting, and by year end, you might see interest rates sort of 1.5% higher. In that type of environment, that's pretty much what the bond market is pricing in right now. So you see in that scenario, bonds are probably neutral, so you just earn your interest income, and there's very little capital movement, and you see far higher interest rates in South Africa. What do we say about investing fixed income then? It's still bonds all the way. We're earning 9%, 10% yields on bonds. I'll take that right now. And, you keep some cash. I think you're going to have buying opportunities later. You want to keep some dry powder. And at the same time, you may want to just dampen risk because it can get uncomfortable, albeit that I think that's still a positive bond environment. Then the final scenario we look at is, well, what if we're wrong? What if oil does push above 120 a barrel? That means that interest rates or that inflation is significantly higher for longer. And that means the Reserve Bank is going to have to act a lot stronger. In that sort of environment, we're talking maybe 2.5% of interest rate hikes, probably this year and next year, it'll be spread out. I think you're talking about a massive, massive impact on consumers. We're teetering on a recession once again, and you're talking about bond yields that are significantly higher. So in that type of environment where inflation continues to run away from us, you really want to own inflation-linked bonds, don't own bonds, and you want to own cash. So that's the sort of scenario environment that we're looking at. So how are we thinking about this? Well, we're thinking that if we look at the balance of probabilities, it's probably scenarios 1 and 2 right now. We do think that there are good structural reasons why inflation will start to peter down. And we do think that as such, you want to continue to be holding bonds. It's been a great asset class year to date, continues to be a good asset class. And I think, from that's how we're looking at bonds domestically. Now, what are we doing? Let's take a bigger picture view here, and I'm just going to chat for sort of 4 or 5 minutes on it. We're taking the view that the US can only hike rates so far before they put the economy into recession. If they, every time they hike interest rates, the economy slows. We're already in a slowing environment. High oil prices are going to slow them further. So we take the view that, peak US rates previously were something like 2.25% to 2.5% is where the US 10-year is probably going to peak, because much above that, it's so much of a handbrake on the US economy that it's going to put them into a recession. I think with the impact of Russia, et cetera, that, those peak rates have maybe declined a little bit. So we're now thinking of the US peak rates somewhere around maybe 2.25, less likely to go much above that. And that's the type of environment that's sort of the type of thinking that we've got. That means that much of the rate hikes in the US are priced in. I think even with the latest price I've seen on bonds was, I think, 1.88%, or 1.9% yield. Actually, going up to 2.25, the pain's already been taken. I think that the global interest rate environment has adjusted and priced in rate hikes, and we're now looking at other things. The next thing we're obviously doing is we're looking and we're running a lot of fire drills behind the scenes here. All the portfolio managers and investment analysts are working through our portfolios. And specifically, we're identifying the shares that are going to be winners, and they are going to be winners. Sibanye is up significantly today. Platinum prices are up significantly today. And there are some of those companies that are actually doing very, very well. We're identifying those. We're looking at how to position in those. And then there are other companies that are going to be taking pain. I think Prosus Naspers is one of the key ones that everyone will be aware of today. We're working on that. We are going to be putting out a more detailed discussion on those companies and our views as soon as we can. It will be on our website today sometime. Peter Little is going to be our author on that document. Last I saw, it's busy working through sort of proof editing. So please do keep an eye out for that if you want to see the more detailed discussion of where we think the winners and losers will be. Looking looking further at the detail, though, we continue to remain positive on bonds. I think, the positive domestic story continues. For a while, we've said from an asset allocation sense, it makes sense for South Africans to be invested abroad. And I think there are two reasons for that. One is there are attractive opportunities. And two, we like to hedge our balance sheets against the risk of something going wrong in South Africa. So having some money offshore gives you a lot of comfort as such. We continue to hold that view, and we continue to hold that investors should make use of their offshore allowances to invest, even though you're going to have speed bumps. The one point we'd make, and I think I made it actually in a previous webinar as well, is that for now, the local is lacquer trade is on, and South African assets have caught a bit of a bid. We're not convinced that this is a long-term structural shift. I think it is an opportunity, though. So what we are looking at is trades to take advantage of this, with a clear understanding that our long-term asset allocation views are different. Our long-term asset allocation view continues to be tilted towards offshore. And then finally, for now, if there is a war up in the Northern Hemisphere in Ukraine and Russia, one of the most furthest places from that is actually the tip of Africa. And South Africa is a bit of a safe haven as such. So, that's probably, speaks to that trade I was talking about. Final aspect of what we're doing is we're looking at cash holdings. Firstly, to have liquidity. Some people are nervous and just want to sit in cash, and we wouldn't advocate for a cut and run at all. But what we do think is it makes sense to have cash. There will be buying opportunities as we go through this. We saw this through the COVID crisis. We will see again that opportunities present themselves, and you want to be ready. You want to have ammunition to take advantage of that when these opportunities present themselves. So from that perspective, we are increasing cash holdings, partly to take off a little bit of risk, partly to sit on the sidelines and identify who the winners will be and be ready to take advantage. So those are kind of the key things going on behind the scenes right now. And we continue to position and manage portfolios as we've been describing. I'm going to end it there, and there you go. And I'm going to sort of open it up for questions. So if you do have questions for Casey or myself, please feel free to type them in right now.
Well, thank you, Nolan, and thank you, Casey. And appreciation from my side of adding the extra Ukraine bit so quickly. We do have a few questions. I've got a couple mailed in and a couple on chat. So let's start if we may. I'm not sure if this is for Casey or Nolan. A question around, if the Ukraine crisis ends immediately, how much damage has already been done? Or can it all be reversed if it ends quickly?
Okay, so let me answer that. Then I've got a very interesting text. I just got the Eskom tariff increases WhatsApp to me 2 seconds ago. So we'll talk about that in a second. We've passed a point of no return. At the point where you take your troops into another country and you go and bomb people, shoot and kill people, at the point where you blow up their installations, that's past the point of no return. The damage is done. I think that global trust for Russia, or Western trust for Russia is maybe a better phrase, is going to be very tough to repair. Even if Russia goes, oops, my bad, sorry about killing 1,000 of your citizens, and walks out right now, it's too late. I think that at the moment, though, we're certainly not in a full-blown war. And if Russia sort of continues to blow up a couple of empty army barracks and then sort of says, look, we've done our saber rattling, backs off, I think that the damage that's done remains. However, it could potentially get a lot worse, a lot more uncomfortable if it goes into full-blown war. So, that's how we're looking at it.
Nolan, do you want to talk about Eskom before I carry on with the question?
Yeah, so 2 seconds ago, I got a WhatsApp, actually 4 minutes ago, I got a WhatsApp saying the South African regulator has granted Eskom a tariff hike of 9.6% for the next 12 months. Good news, that's less than the 14% that we had for them in the bar chart I had earlier. So that's come down. The bad news is Eskom's going to go and complain, and they're going to try and challenge it, so it'll go up again. But we got a starting point, and that's probably slightly deflationary. So I think that might be positive news for our markets in due course.
And Nolan, question for you. When is the next SARB interest rate decision, and what do you expect it to increase by? Well, I suppose decrease by if...
I think I might have covered that. So
let me repeat
I don't
that.
have the exact meeting date. The meeting is in March next month, towards the end of next month. Casey may have the exact date at hand. And we expect a hike of 0.25%.
Next question, I think this is for you again, Nolan. Given that you are painting a rosier picture of South Africa, could we see less interest rate hikes in South Africa than previously anticipated?
Less interest rate hikes than represented?
Than previously anticipated.
It depends on what your anticipation was, I guess. Casey, do you want to take that actually? Just give you a chance to chat to one.
Yeah, thanks, Nolan. Off the back of that, I think we remain sort of head fast on our base case. You know, if you had asked me this question a day ago, even before we woke up to this morning's news, we would have said a case of another 3 to 4 interest rate hikes this year. So what, there would be 25 basis points each or so, and to take us to a repo rate of 4.75 to 5%. I still believe we're firmly in that camp. At the end of the day, I mean, I know there's a big what if scenario at play at the moment, so I'm tentative to put forecasts forward. But as it stands, inflation in the day within South Africa remains contained. We still have a little while till we blow out to the levels that would force the SARB to front load. This is, of course, notwithstanding the effects of the Fed as well. So I'm still comfortable to around 3 or 4 further hikes. The March meeting, Nolan, the date is the 24th of March. And yeah, we're still anticipating another hike within this quarter. Coming around to around Q3, I believe we will start pausing, or more towards Q2 mid-year, and then see pack hikes again, possibly in Q3, Q4. Our SARB is very patient. They play the long game, and they will never rush into any forward hikes. I don't want to add any more, Nolan.
Yeah, sure. I think that if we look at, our expectations, they haven't changed. I think they're exactly as Casey outlined. Where it gets interesting to us was that the bond market was pricing in the equivalent of about 2% of further interest rate hikes this year. And we don't think that's going to happen. We haven't ever thought that's going to happen, actually. Therefore, relative to the bond market, I think that we're going to see far fewer hikes, and that's why we think bonds are attractive. Relative to our expectations, which actually align with most of the major economist expectations in SA, I don't think this really changes our views. Another 0.75 to 1% of rate hikes this year.
Nolan, question for you. This situation is good for South Africa because of commodity prices. Is it good for the rest of Africa?
Yeah, maybe, probably, possibly a little. The rest of Africa, South Africa's export basket is different to most of Africa. Most of Africa is either an oil exporter, Nigeria, Ghana, etc., Senegal, Gabon. The thing is their ability to increase supply is limited. Nigeria is already battling to produce their OPEC quota of oil, and therefore they can't really capitalize on higher prices because they can't get the oil out of the ground. Ghana's got a problem that the oil's in particularly salty areas in the seabed, and the machines they're using aren't coping with it particularly well, so they're constantly fighting breakages, etc. So can that produce increased volume? No. Will they benefit from a 20% increase in export volumes? Yes. But it's probably not enough to really move the dial much. I don't know what Casey's perspective is. She also focused on a couple of African countries. So I think I'll hand over to Casey on those. Where it could be more interesting is something like Kenya, that's more dependent on agricultural exports. I think they potentially stand to benefit a bit further.
Yeah, no, I think you pretty much nailed it there. If you want to add a little bit more detail, if you take the likes of Angola, for instance, where 97% of our export basket is around oil, You would expect to see some strength sort of coming off from there, but unfortunately, they're suffering some severe infrastructure-related issues to their oil production. They've been battling to meet quotas, much as Nigeria has. So off the back of that, it could be, in a sense, fairly neutral around the African market. Yes, they'll get a bit of a boom in from certain key exports, but at the end of the day, a vast majority of Africa remain oil importers, and they're going to suffer equally with higher inflation off the back of a higher petrol price. So the two factors will probably end up negating themselves out.
And Nolan, I do believe you answered this in your presentation, but you may want to expand on it. With US inflation greater than South Africa, do you see rand strength?
There are a number of factors that feed into the value of the rand. Inflation differentials is a useful economic model, but A, the markets never follow that, and B, there are a lot of other factors we've got to be aware of. We've talked about terms of trade swinging more positive for SA. We've talked about the inflation differential actually supporting the rand. We've talked about the fact that actually, foreign investors who are forced to hold emerging markets right now will naturally overweight South Africa as just an investment destination. So there are a lot of positives out there. How positive? I think the rand probably is going to be supported. We said at the beginning of the year that the rand would hover just above 15 for the first quarter. And then we said that during the second quarter, we thought the rand would probably drop through the 15 level to, the high 14s. I don't know, something 1480, 1475 or something. Not convinced we're going to change our view on that. I think the rand continues to be well supported.
Question for you, Nolan. Can you comment about listed properties placed within an income portfolio for 2022?
That's a lot I can say, and I don't have much time. So in terms of listed property, it was a big story last year. I think listed property was up 50%, was a massive rebound from the COVID sell-off. If I'm honest, it's probably something we missed a bit of. I regret not holding more property. But as we sit here today, I think that much of that rebound is done. And we're now looking at dividends that have come back. Dividend yields on property is 7.5% to 8%. And that's lower than it was previously. It's lower than it was previously because the companies, the REITs, are withholding some of their cash flow for maintenance they weren't doing previously, so up to 20%. So that impacts your dividend yield. That's kind of in the price. But at 7-8% dividend yield, property is okay as long as you believe there's going to be growth. I can buy a 10-year bond yielding 10%. Do I really want an 8% property? And I only want that if that dividend is going to grow. So it's all about growth rates. Where are we seeing growth right now? We think that there's some further recovery that can come from increased footfall through shopping malls. Most of the malls are saying that they're seeing turnover probably back to where it was pre-COVID, but they haven't seen the footfall increase. The footfall is still lower, and maybe that's travelers, foreigners, tourists coming back to our shores would certainly help. So there's a little bit of a bounce that might come from that. And then some of the offshore property counters were looking a lot better. I think we're going to be a bit careful because a lot of that's concentrated in Eastern Europe right now. So I think there may be pressure for the near term. As such, we were underweight listed property. We got that a bit wrong, but we've been even further decreasing it this year, saying we missed out on the run, but it's not the time to double down on it. It's actually probably a time to take a bit more off the table. So that's been the strategy through our fixed income team.
I think, okay, final question for today. I think this is maybe for you, Casey, I'm not sure. With the current situation coming out of COVID and now Ukraine, will this affect the logistical situation around the world? Do we expect long queues at ports, and are we expecting to see further increases and further weights on vehicles?
All right, yeah, no, I'm happy to tackle that one. I was actually reading up on a few articles on this morning amidst our last minute presentation panic. Yes, it's going to further constrain supply chains at the short end of it. The last I read earlier, just before we started, is that Russia had already taken control of a few key ports along Ukraine and taken over sort of seafaring within the area. So we know before this all started, we were already under some severe supply chain constraints, so unwinding themselves off the back of COVID. A situation such as this towards the eastern part of Europe is just not going to help, to be honest. It's just going to further exacerbate. The big question, to be, I think, frank, would be the extent of it. How long does this play out? Is this a situation that we are going to see for a few more days, then short-term spike? If this is a prolonged, protracted situation, we see further embargoes, sanctions, etc., placed from the West onto Russia, it's just going to spiral further. And yeah, we can, I think, expect a few delays coming out. Again, the key question will be duration of the conflict.
Casey, I don't know if you want to specifically talk about vehicles in the question, or if you don't have a specific comment around it.
I don't have too much of a specific comment on vehicles. That will sort of just be lobbed into the general category, really.
Fantastic. Thank you, everybody. That concludes our questions for today. Thank you very, very much for joining us. As always, when we get the CPD certificates, we will mail it to you. Thank you very much. Thank you, Nolan. Thank you, Casey. See you next month at Essentials. Goodbye, everybody.